Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Welcome to another edition of In Conversation with DLC's chief economist, very own Dr. Sherry Cooper. I'll be your host today, and no, I'm not our president, Eddy Cocciollo. Eddy decided to hide today from today's latest Bank of Canada meeting announcement, but rather he decided to go on a very well-deserved vacation with his family. So my name is Greg Domville. I'm the VP of Training and Brokerage Development for Western Canada here at Dominion Lending Centres. Today's show is brought to you by our amazing partner and sponsor, First Canadian Title. Dominion has more than 4,200 mortgage professionals with over 300 franchises right across Canada from coast to coast. Our army of professionals are here to answer any questions you may have and help you with all your mortgage needs. Visit dominionlendingcenters.ca to find a DLC mortgage expert near you. Our chief economist, Dr. Sherry Cooper, with over 30 years of experience in one of Canada's most highly respected economists in Canada, and today's episode will be focused around today's Bank of Canada announcement and yet another Bank of Canada rate hike, which we are here to answer your questions. Questions like, will there be more upward hiking trips from Bank of Canada? Do you have a strong desire to stay up to date on the Canadian economic trends? Are you curious about potential changes that may occur in the Canadian real estate and mortgage market? So after today's announcement of another 25 bp rate increase, we're here to answer your questions, address your fears and concerns, and help you better address on what you should do with your personal mortgage goals. Whether you're looking to buy your first home, purchase an investment property, refinance your existing mortgage, lock in an existing variable rate to a fixed, or simply you're nearing the end of your existing term where it's time to negotiate the best product for your next term, DLC and Dr. Sherry Cooper are here to help navigate through all your questions. Bank of Canada raised its policy by 25 bips today. There now has been 10 interest rate hikes over the last 16 months, with Bank of Canada's key interest rate moving from 0.25% to today at 5%. And this is the first time we've been at 5% in 22 years. So we're now streaming live on YouTube, LinkedIn, Twitter, and other platform sessions in this conversation with Dr. Sherry Cooper. Please, if you have comments or questions, type them into your comment section at any time during the show, and I'll table them for Dr. Sherry Cooper to address at the end of her presentation. So with no further delay, let's welcome Dr. Sherry Cooper to the show. Buckle up, sit back, and let's get into the know about the economic forecast of the remainder of 23 and 2024. Welcome, Dr. Sherry. So nice to see you again.
Thank you, Greg. Great to see you, and happy to be here talking to all of you on this propitious day. Oh my God.
It is a day. It is a day for sure. It's not all doom and gloom.
What's happened today is this morning, the U.S. June CPI data came out, and the inflation numbers were great. Inflation fell in June to a mere 3%, down from 4% in May. And as a result, around the world, markets are rallying. both stock and bond markets. So interest rates have edged downward, and we've seen the stock markets improve. Now, at the same time, just an hour and a half later, the Bank of Canada came out and told us that they had raised rates again to 5%. Now, this was widely expected. I think for the first time in certainly my memory, all 6 big Canadian bank economists announced that they expected the bank to raise interest rates. So it wasn't a shock at all. But nevertheless, there are parts of what the bank did that are surprising. But let's go through what the bank saw. The economy in Canada does remain resilient. We've seen in Canada that the last data that we have is for the first quarter, and the first quarter data were very strong, 3.1% growth. Now, more recently, we've seen the monthly numbers. April, not so good, but the flash estimate for May is another pickup in growth. So the bank said that in their monetary policy report today, that they expect growth to average 1% through the rest of this year and the first half of that should be 2024. I was typing very fast this morning. So sorry about that. That means that the bank is not forecasting recession. If they get what they're expecting, and they rarely do, this will be a soft landing in the economy. What we've seen is that certainly households continue to spend money. The consumer spending numbers have been incredibly strong, despite the fact that household debt to income ratios are very near historical highs and are among the highest in the developed world. In fact, I think it is the highest. But remember that at the same time, household net worth has increased sharply. So households, and in fact, the bank did a deep dive into the financial condition of households in their report today, and basically concluded that household financial positions are actually quite strong. Now, household credit market debt in the first quarter, we saw a plunge in mortgage originations. They're down 42% year over year, the direct result of those 10 rate hikes that Greg was just mentioning. They're below pre-pandemic levels for the GTA and the greater Vancouver area, and as well from fewer first-time home buyers. And May, we saw a strength in housing. April, May were good in housing. And that's what spooked the Bank of Canada, in my view. So they raised rates unexpectedly in June and then have come back again and raised rates. So they're on the warpath. They want to see housing slow. First-time home buyers have been squeezed out of this. The average new monthly mortgage payment relative to the new mortgage average loan amount, it makes it very difficult for first-time home buyers to get into this market. Not to mention that we've also got a lack of inventory, as we've seen, in fact, over the course of this cycle, a lack of inventory. So it remains a seller's market. We have seen, however, credit card delinquency rates rising. So many households, and these may not be the homeowner households, but certainly many have been hurt by the rapid increases in prices. The prices of essential goods like food and shelter have risen very sharply. People rely on their credit cards and then can't make the full payments each month. So the household savings rate has declined, but consumer spending has surged. Now, the Bank of Canada has made a big deal, not about the savings rate, but about the level of savings. The level of savings remains very high. And that's because during those pandemic years, the lockdown years, people had nowhere to go, so they didn't spend money. And the savings rate surged. You can see that in this chart here. And not only that, but even people that were unemployed were getting CERB payments. And so we did see big accumulation of savings and, of course, huge pent-up demand. So evidently, consumers are still blowing off that pent-up demand, and we continue to see strong numbers there. Now, more recently, we've seen consumer and business insolvencies rising. So, especially for businesses, they're under pressure, both because of the lagged effects of all that lockdown. There are not deep pockets in so many, particularly smaller Canadian businesses. But also the competition is fierce. People are still buying things online, and many of the most well-known retailers are American companies. Amazon, of course, is the best example. Now, the labor markets. We've seen significant changes in the labor markets, but they are still tight. The Bank of Canada made a big deal of that when they announced the rate increase. And it's not surprising. You see that the May number was a huge increase in net new job creation. So almost 60 billion. And that is, million. That is really, that was about 3 times the expected number. So that was probably the most important factor contributing to the rate hike today. And the gains were in full-time work. You can see from these charts that full-time increased sharply and part-time work just collapsed. So that, of course, is good news for households. The labor force participation rate surged in June. In other words, the percentage of the adult population that is employed has, in the labor force, they're either employed or looking for work, increased by more than 31,000. And that's part of the reason why the unemployment rate increased. When you've got a pool, in other words, a total labor force that gets bigger and bigger, the numbers for unemployment relative to that pool actually look like they are increasing, because many of the new entrants into our labor force have only arrived in the last several months or over the last year. And the bank made a big deal in their comments today about this 5.4% unemployment number. Yes, it is up from 5%, which was a record low, actually very close to the 4.9% record low. But 5.4% is still considered way too tight. In fact, before the pandemic began, we considered ourselves to be at full employment, and back then the unemployment rate was 5.7%. So it's the unemployment rate hasn't risen enough to satisfy the Bank of Canada. And this looks at job vacancies. New entrants to Canada have gotten jobs, and many of them very quickly, and we've seen the job vacancies and the job vacancy rates come down. But when you compare it to the history, and this big empty space here was because during the pandemic, they stopped collecting the data. So you see that even at 4.5% job vacancy rate, it is considerably higher than historical standards. And then this funny looking chart, again, because of the gap in the data, shows you that the labor markets are in fact getting less tight, I guess is the best way to put it. The unemployment relative to the job vacancy ratio, which is this blue line, has started turning up. But again, it's nowhere near where it should be if the labor markets were at full employment. So on a sustainable basis. And look what we've seen in wage inflation. The latest data show us for June, and that's as current a number as we have, that wage inflation has finally broken through the forecast months of over 5% inflation. But nevertheless, the Bank of Canada said that 4 to 5% wage inflation growth is just too much. So now maybe the strike on the West Coast, the dock workers, will further reduce those numbers. But once the strike is settled, those workers are going to get an increase, and that will add to the wage inflation number. So there are headwinds in the economy. Consumer non-mortgage debt is rising. As I mentioned before, credit card delinquencies are rising. Wage gains have been less than price inflation, so households are still feeling the pinch. And monthly payments on variable rate mortgages and certainly the ones that don't have fixed payments, as well as the home equity loan, have risen in lockstep with the Bank of Canada's every move. And that drains, of course, the discretionary income. And early mortgage delinquencies, in other words, less than 3 months delinquent, are on the rise. But inflation is, of course, what the Bank of Canada is targeting. Inflation still is a big problem. Now, the CPI inflation did fall sharply in May to 3.4%. Remember, I told you that US inflation in June was at 3%. So pretty much everywhere in the world, inflation has come off the boil. But a lot of it is the result of just two factors. One, energy prices have fallen, but the other one is what economists call the base effect. In other words, when you look at a year-over-year inflation number for May, you're comparing today's inflation or May's inflation relative to May a year ago. And what's happening is the very high inflation numbers are dropping out of the calculation because they were more than a year ago. So it looks like price increases from this level, let's say, are in fact smaller than from this level. So it's not a real snapshot of what's happening now. And that's why the Bank of Canada likes to look at the 3-month inflation numbers. And here you see that in June, they're going to be another easy month for low inflation comparisons. This shows you the June of last year. It was very strong. So June this year will look better. But remember, that is, in fact, a factor that the bank looks through by looking at the 3-month inflation rate rather than just the year over year. And in May, we saw that gasoline prices led the decline. For June, gasoline prices haven't fallen as much as it did in May, but other energy prices are down. The Canadian gasoline prices plunged year over year, and this is a fact that, of course, contributes to the slowdown in inflation. We've also seen easing supply chain disruptions. Now, that may be reversed by the temporary strike of the dock workers in Vancouver. Our Vancouver port is our number one port as far as the distribution of goods coming from outside the country, as well as our exports to other countries. Most of that goes through Vancouver. So that's just another temporary disruption. And everyone is talking about how increases in interest rates add to inflation. And that's what Tiff Macklem called today a technical truth. The fact is that almost a third of CPI inflation is the result of the shelter component of CPI, which includes those who rent as well as the imputed cost. It's an estimated cost of what the value of owning a home is. And of course, because the prices have risen everywhere, monthly payments as well as the actual new purchases contribute to the rising shelter component. But for one thing, mortgage interest costs alone are only 3%. In other words, 3% of the CPI index, which means 97% of it has nothing to do with mortgage interest. And that's my first point. But also, there are so many other prices that are extremely sticky. And food has been one of them. Yes, food inflation has come down from those incredible double-digit numbers, but they remain at 8.3%. And that means, it's not as though it's 8.3% from reasonable levels. It's 8.3% higher from already inflated food prices. So they continue to go up and up and up. And anybody who goes grocery shopping notices that they have fewer bags and higher checkout amounts. So it's a very real factor. Now, what the Bank of Canada and all the central banks like to do is look at core inflation to see what is the sticky price inflation. In other words, take out the most volatile components. And we've always historically looked at CPI inflation, less food and energy. But now they're taking out the shelter component as well. The Fed started doing this. The Bank of Canada is doing it as well. The Fed calls it super core inflation to eliminate the impact of higher interest rates, the direct impact of higher interest rates on the CPI. And that's this line here. That level, super core inflation, is higher than the other traditional core inflation numbers, and it's actually edging upward. So we can safely say that core inflation is very sticky, and there's a big deal made of that in the publications of the Bank of Canada today. And I listened to Tiff Macklem's press conference, and he made that point over and over and over again. There were people on the line as well as in the room. These are generally the media, but there were also some economists that were asking questions. A lot of them asked about, well, don't higher interest rates actually directly contribute to inflation? And yes, that's technically true, but the fact is that they slow spending. And as a result of that, we begin to see price pressures dissipate. So the Bank of Canada increased rates, as everyone knows, 25 beeps to 5%, highest rates in 22 years. But I think the most notable extra thing that the bank said today was they said that the achievement of the 2% target is going to take longer than they expected. So whereas in the past they believed that we would hit the 2% target in 2024, now they've postponed it to mid-2025. And that means that rates are going to stay high for longer, is the basic situation. Now, there were many that had forecast that interest rates would peak this year, 2023, and begin to fall in the second half of this year. I have long been saying, no way. It takes much longer to break the back of inflation than that. Then generally the consensus view is that interest rates are going to be cut sometime in the first half to the middle of 2024. I'm suggesting the bank now will hold interest rates higher for longer, which is a very important component going into the decision of whether a mortgage loan should be fixed or variable rate. So we see those 10 increases. This is by far the largest percentage increase in interest rates in history, or even modern history, certainly since the data began to be collected on a regular basis. And anybody who has a variable rate mortgage, whether it's fixed payment or flexible payment, knows what a big impact this has made on the cost of home ownership. It's just a huge impact. Now, with the increase in the overnight policy rate, we're going to see the prime rate move to 7.2%. It wasn't reflected in the data yet. It's still at 6.95 because technically the banks don't increase the prime rate until after the bank's announcement. But later today or tomorrow, we'll see that all the big banks, in fact, all the mortgage lenders, will have increased their variable rate mortgage rates. And the variable rates will remain higher than the fixed rates. Now, this is a very interesting chart. The 5-year Government of Canada yield, which usually is an indicator of what fixed mortgage rates will trend towards, that rate fell today. It had been hovering around 4%. In fact, it breached 4% to 4.029% in the last month. But it was hovering very close to 4% yesterday. It has fallen today for one reason, having nothing to do with Canada. And look at what happened to the 2-year yield in the US. This is the direct result of the better than expected, lower than expected CPI inflation numbers that came out this morning in the US. And it shows you how closely linked the Canadian and US markets are. The US market drives the bus in terms of big movements. But that doesn't mean that relatively the Canadian interest rates relative to the US will not rise. They certainly will. But for now, we have a breather in terms of the pressures on fixed rates, even though the Bank of Canada did hike the overnight rate. We've got an inverted yield curve. This looks at the spread between the 2-year yield and the 10-year yield in Canada. That's before this morning. So you see that it's an inverted yield, but nevertheless, it's like minus 133 basis points. But that is usually a precursor to recession. Not always, but usually. But these things are very volatile. So the Bank of Canada doesn't buy this story. They do not believe we're going to move into a technical recession, meaning 2 consecutive quarters of negative growth, as well as a substantial tightening in spending. But it does not. Right now, their forecast is that it will be a softer landing than that, which is not such a good thing because it means it's going to take longer to get inflation back to its target. Credit availability has tightened. Businesses are suggesting higher borrowing costs are causing difficulty. They're also saying that labor markets, it's not as difficult to get new employees as it was earlier in this cycle. Now, in June, the housing markets were spooked by the rate hikes. We saw a burst of activity in April and May. The Bank of Canada didn't like that. And as a result, the tightening of rates in June, there were buyers that became more cautious, and sellers as well, for that matter. New listings did pick up in May, but they're still very low relative to sales. You see that the May home sales did build on the April figures, but when we get the June data for the national data, they're likely to continue to reflect what we've already seen with the regional real estate boards have announced, that the sales did dip in June, certainly in Toronto and in Vancouver. Now, the new listings did edge higher in May. I mean, a 6.8% month over month increase is not that bad, but they still remain historically very, very low relative to the volume of demand. So economy-wide strains in consumer balance sheets begin to show now in early delinquencies. The Bank of Canada, as I mentioned earlier, still believes that consumers in Canada are in great shape. And that's certainly true in the aggregate. Now, new listings have been a major issue. There's just nothing to buy out there, as home buyers are suggesting. And potential sellers, with the rise in interest rates, actually believe that it's not a good time to put your house on the market. So they've remained on the sidelines. Also keep in mind that unless a seller is going to be in the rental market, they're going to have to get another mortgage if they're moving up. And of course, mortgage rates surging means that they'll be reluctant to give up the mortgage that they have right now. So given they can't port the mortgage in most cases, that's another reason that has kept inventories very tight. Now, home prices did move up in May, and price pressures are still there because of the huge increase in the growth of the population in Canada. But these price levels do remain below the peak in home prices on an aggregate basis. And you see that another problem in the housing market is that investors, potential investors, and those investors who bought in the last couple of years have negative carry. And so that also has slowed the demand for rental properties. So as a result of the huge increase in interest rates, we've seen a major shift from the variable rate loans to the demand for fixed rate loans. So as of April, only 8% of new mortgage originations had a variable rate, and that was down from a peak of almost 57% in January of 2022, before the Bank of Canada began to tighten monetary policy. It's also interesting to note that around that time, late 2021, January of 2022, the Bank of Canada suggested that interest rates will remain at very low levels for an extended period. That's something that the banks, the central banks in most of the world said, and they certainly proved to be wrong because they, at that time, believed that inflation was transitory. People read that to mean that the rise in prices would be short-lived. Transitory just means that it was temporary, and it's not supposed to suggest when or for how long prices would remain high. But nevertheless, I think it's fair to say the central banks were wrong about this, and that the big tightening unfortunately caused people who did get mortgages at these historically low levels, and most of those mortgages were variable rate at the time. They have suffered as a result. Certainly those with adjustable payments, but even those with the fixed payments have had to either make lump sum payments or see negative amortization of their loans. So looking at new mortgage originations, the most popular variable rate mortgage has been, fixed rate mortgage has been the 3-year fixed rate. Now, I think that calculation may begin to shift because the Bank of Canada, I believe, will keep rates higher for longer. And I think there are going to be more people that just don't want to take the risk. And so maybe the 5-year term will increase in popularity. Now, many variable rate borrowers that have fixed payments have hit their trigger points, which means that their monthly payment has not covered their interest rates, the interest payments on the remaining mortgage balance. And that's exactly what negative amortization means. Now, OSFI has long been telegraphing that they don't like this negative amortization. Now, they have said that they expect more prudent and active account management approach, including resolving negative mortgage amortization at the earliest opportunity. Then, very recently, OSFI raised the capital requirements on banks for a second time in 6 months. And capital isn't cheap. So that means that banks will now, credit will be less available. It's doing exactly what OSFI wanted to see, that the banks take less risk. As well, the Canadian banks have very strong capital levels. Now the big six are all above the new regulatory minimum of 11.5% of risk-weighted assets. But OSFI just on the 11th of July, a day ago, yesterday, announced that a proposal for a change, and that change would be to increase the capital requirement on risk-weighted assets, focusing on assets that have negative amortization. They want to increase the capital requirement on those loans, which will mean, if it happens, that they will discourage banks from negatively amortizing, which means that the banks themselves will be more reluctant to issue fixed payment variable rate mortgages, as long as they believe that interest rates will remain high. So OSFI is doing one thing. The banks themselves have seen BMO, CIBC, and Royal have said that their mortgage amortizations have risen considerably. But they've also suggested that they would revert to original amortization schedules for variable rate loans renewing in 2025 and 2026, which, according to the Bank of Canada's estimate, means that monthly payments will rise by 40% or more for people who have not paid down the principal. In other words, have not made lump sum payments. And for fixed rate mortgages, the Bank of Canada estimates that for those who have to renew in 2025, 2026, their payments will rise by 20 to 25%. And this is a chart done by McLister. It just shows you don't want a 90-year amortization. I mean, you don't want a mortgage that increases, because it reduces your monthly payments by a mere 23%, but the interest costs on the total loan ultimately rise by 374%. So it's not a good thing for this to be happening, and consumers should be very reluctant to take out longer-term mortgage loans. Now, just to show you how much the different federal agencies are at cross purposes, we have seen just in the last week, or maybe a little more than a week, that the consumer watchdog has said that the banks need to be very concerned about those consumers that potentially would default if they didn't have negative amortization. And they put out new mortgage relief guidelines. They provide temporary mortgage relief for those people that are in trouble already, to waive prepayment penalties, waive internal fees and costs, avoid charging interest on interest, because the reason their mortgage is getting bigger and bigger, or their truly the amortization of the remaining loan balance is getting longer and longer, is because they're not even covering their interest payments by their monthly mortgage payment. And to extend amortizations, that's what they're calling for the shortest period possible, and ensure that there would be no adverse credit reporting for these households. Now, this applies only to the federally regulated financial institutions, the very same institutions that OSFI is trying to discourage from making fixed payment variable rate loans. So you can't have it both ways, obviously. Now, the bottom line here is that the housing market suffers from a shortage of supply, not just because of a shortage of sellers of existing homes, but certainly the new construction has been far, far less than what is required, given that we saw 1.2 million more people come into Canada in the last 12 months. So international migration has spiked. Canadian population growth is at 2.7%. Now, to put that in perspective, not only is that the highest population growth in the G7, it's the highest population growth among all developed economies. It's the fastest population growth that rivals the least developed countries. These three countries in Africa have roughly the same population growth as Canada, which is unheard of. And you see that record high population growth is going to continue because the government has planned that by 2025, 500,000 new immigrants will come into Canada. And that only includes the economic immigration. It doesn't include the other, like the students, the foreign students that become Canadian citizens, as well as those people who are living in countries that they feel that they have to leave because of danger to themselves. In 2022, Canada welcomed 437,000 immigrants and saw a net increase of non-permanent residents that were estimated at over 600,000, which was by far the largest component of population growth. And now Ottawa wants to make them permanent residents. So any way you look at it, our population is going to grow. Now, at the same time, we've seen surging construction costs, which certainly has had a strong negative impact on residential construction. So that is a big, big problem. Construction costs are up 51% since the start of the pandemic, while the CPI has increased 13%. Municipal development fees are tied to construction costs, so they've surged as well. Labor shortages and rising wages have increased the labor costs for construction by 9.4%. And expanding production of the inputs that go into construction, like cement and lumber, might be precluded both by the environmental impact and then, of course, the forest fires. The forest fires have tremendously disrupted the production of lumber, and lumber prices have increased considerably. So you see here the impact to an impediment to home construction is just the surge in the cost of construction, not to mention the delays in the zoning issues and so many other impediments. And so we've seen housing starts fall, which confounds Trudeau's goal of doubling housing construction to improve affordability. And in the most recent election campaign, the mayoral election in Toronto, housing construction, affordable housing was, I'd say, the number one issue among the contenders. And we'll see what happens. But clearly, everybody's promising more affordable housing. We'll see how that goes. Now, immigration is great for stronger economic activity. And in the aggregate, stronger consumer spending. But productivity growth in Canada is falling. So income inequality is likely to rise, and we see that per capita GDP is likely to fall as a result of this. So in other words, we'll see a growing proportion of the population that needs affordable housing. And that means the underlying momentum for home prices is certainly up, which is the opposite of what we need to see. But the demand for housing will continue to exceed the supply of housing, in my view, for the foreseeable future. So that ends my prepared remarks, and I'm happy now to look at and open it up for questions, and I'm sure there's questions out there.
There certainly is, Sherry. Great job. Thank you so much. You're just a wealth of information. You're smarter than beyond belief. So just can't thank you enough for being here again and just helping us get in the know as to what's going on in the economy. There's just lots of factors. So we do have some questions. We got about 10 minutes left, so we'll have to bang through these quite quickly. But I just wanted to quickly ask my own first question before I dive through the list here of comments. The question was this: you said it a few times that we had such a very strong housing market in April and May, and I personally have felt that with the rise of originations. But you said a couple of times that spike in the housing market has spooked Bank of Canada, which they want to then in turn slow down the housing. So why does increase in housing spook them, where they want to slow it down?
Because the most interest-sensitive sector of the economy is housing. And housing is the transmission mechanism of monetary tightening. The way the theory goes is when interest rates rise, credit becomes more expensive. And the most interest-sensitive sector, of course, is the most expensive, and nobody spends as much money, or few people spend more money on something than a house. So it is supposed to be very interest sensitive. And when they saw that housing could pick up simply because the Bank of Canada was on pause, they decided that they hadn't raised interest rates enough.
Gotcha. Okay. Thanks for that. Let's turn to the questions. And again, we have about 9 minutes, so we'll go through these as quickly as we can. Hopefully we can get to everyone. So the first question that came in, or comment from Dennis, just reading enough off the screen here. Dennis, thanks for the comment. I know Bank of Canada talked about rates will stay up until the end of 2024. Now they're saying mid-2025. What's the sense of the long rates when they say they can go down? What does that mean? I know you can't predict the future, but...
Well, I mean, the Bank of Canada is now they're more reluctant to tell you when they're going to cut rates because they don't know. Of course they don't know. But what they're telling you today is that rates are going to stay high longer than they expected, longer by at least 6 months longer than what they had expected. Yeah. And that's all data dependent. And they made that point, like they always do, depending on the incoming numbers. But barring something highly unexpected, interest rates for sure are going to stay higher longer, and they might even increase interest rates again. And it will all depend on the economy and inflation. And a very, very important component of that is housing.
Fair enough.
So, and they mean business. It's everything, the body language from, the press conference, the repetition of, we're going to do whatever it takes to get inflation at 2% on a sustainable basis. Not 3, not 2.5, but 2.
Got it. All right. Well, then we talk about inflation a lot. And so our next comment, with inflation going down, Yet grocery bills are still soaring through the roof, which you said, and we all feel like, why is inflation going down, but grocery prices are going up?
Because inflation is just the rise in prices. When inflation increases, it's increasing at 2%, that doesn't mean that prices are falling.
Right.
In other words, of course, some prices fall, particularly those prices that are priced in global markets, like energy. Energy skyrocketed at the beginning of the Ukraine war because of the disruption in oil exports to the rest of the world from Russia. And then since then, energy prices have come down. But most prices are sticky on the downside. Rents, for example. They're not going to cut your rent unless we see a collapse in demand and you move out. You might be able to move out into a lower rental situation for a comparable apartment. But if you just stay where you are, the chances of them cutting your condo fees or cutting rent is very unlikely. Now, food prices do adjust in sometimes global markets. And so you see fresh produce prices go up and down. Egg prices have come down from very high levels. But I mean, in general, 2% inflation from very high levels is what we should expect.
All right, so I'm going to put Monique's question on the screen here next because she's going to speak to a few of them that come up for comments-wise. But it has to do with, everyone's spending more and the TDSs are high, their debt-to-service ratios are high, so there's lots of delinquency. But yet we have all this focus on mortgages. So to read Monique's comment here, I would love to understand why housing is attacked during high inflation versus the revolving debt, like credit cards and personal loans. It's so easy to get a credit card.
It's not you think of it as housing is attacked, but the fact is it's not. Don't take it personally. I know it affects us way more, our industry, way more than it does other sectors. But again, we saw booming housing markets when the overnight rate was at 25 basis points. They made a huge mistake. They lowered rates too much and they kept them there too long. And now they're reversing that mistake. But the reason housing is the sector that's hardest hit is simply because it's the most interest sensitive sector. And the only policy they've got is changing interest rates. The federal government could cut taxes or raise taxes. They could cut or raise government spending, but they're not willing to do any of that. And the federal government is probably too easy. So if they were to raise taxes right now, that would slow the economy big time. But they're not doing it because they are politicians and want to be reelected. Tiff Macklem doesn't have to be reelected.
All right, well, looking at the time, we probably have time for one more question from the audience, and I'll do some wrap-up takeaways. But from Len Lane, I'm going to put you on the spot, or we're going to put you on the spot, Sherry. Len Lane's asking, do you feel that a 3-year fix is a gamble at this time when they're predicting that they're going to potentially fall mid-2005?
It's a gamble. For years and years, I've been telling people that I wouldn't take a variable rate loan. And that's just me, because I like to sleep at night and I'm risk averse. And I am old enough to remember when interest rates were at 20%. And in fact, I was at the Fed then. I was working with Paul Volcker, and I knew how hard it was to get inflation down. And so people who write, people under 50, maybe even especially those under 40, believe that interest rates do nothing but fall, because over the course of your life, or at least when you were paying attention, interest rates only fell. So people write things that say variable rate loans are always a better deal than fixed rate loans, or historically they're a better deal. Well, if history began since 1982, that's correct. But history, in fact, goes back further than 1982. And we're in a situation now that's reminiscent of that period. Now, there's lots of reasons why it's not as bad. It's not as bad because inflation isn't at 15% or 10%, but it is also worse because interest rates were so low to begin with.
Correct.
At 25 basis points. Back then, interest rates went from like 8% to 13%. That's not even the doubling of interest rates. Now they've gone from 0.25% to 500 basis points. I mean, what percentage is that? It's just enormous. So monthly payments are going up way more than ever before.
Well, once again, Sherry, thank you so much for the last hour and spending the time with us so we can get into the know. Just a quick recap, my three biggest takeaways, not all doom and gloom. Yes, the Bank of Canada has achieved their target of 2%, and it's probably going to hold now for a good another year and a half. But
wait, I didn't say that. They have not achieved their target of 2%. Inflation
proposed.
is about 2%.
Right, their target is 2%.
I cannot say they're going to hold for a year and a half. They will not.
Right.
They will not say that. If the numbers continue to suggest that they haven't tightened enough in their mind, interest rates will rise. What I did say is interest rates are going to remain high for longer than expected, which suggests they may not even cut rates next year.
Correct. I agree. Thanks for that clarification. Okay, so just a big thanks one more time. Our sponsor, FCT, First Canadian Title, for being here on the show with us. I want to remind us all that our next In Conversation with Dr. Sherry Cooper is going to be held at the next Bank of Canada meeting on September 6, 2023. So we'll be here same time, same date on September the 6th. Once again, thank you, FCT. Thank you, Dr. Sherry Cooper, for the great information and insight on what's going to happen over the next 6 months to year and a half ahead of us. Appreciate your time.
You're welcome. Bye-bye.